Hello and welcome to Hedge Fund Tips with Tom Hayes. This is VideoCast episode 57, podcast episode 47 for the week ending November 20th, 2020. So welcome, exciting week. And as we always do, I want to kick off with some of our media spots because that's where we cover the most amount of material in the shortest amount of time in condensed format. So to kick it off, I'd like to thank Liz Clayman, Jacqueline D'Ambrosi Scales, and of course Ellie Terrett. She was out on Thursday when I was on the show, but thanks to all three for having me on Thursday. And we covered quite a bit in a short clip. You can review all of these under the featured on button at the top of hedgefundtips.com. You just click on that. They all come up and you can watch the short video clips. So in this segment, Liz was asking me about short-term volatility because the VIX had fallen materially from 40 down to 23, 24, and were investors getting too complacent? I think she said it was down 39% this month. And there is some complacency and there is some froth coming in. But if you look out historically, as we covered, I believe 2 weeks ago on our podcast VideoCast, if you want to actually call a top in a market, the place to call a top in a market is when the VIX hits 10. But what I said in the segment was where I'd start to get aggressively defensive or start to get somewhat defensive is if the VIX dropped below 15. So while we could get bouts of volatility in the short term or a little bit of turbulence at 23 at this elevated level of high implied volatility and expensive insurance. Remember I said when insurance is expensive, you want to be selling insurance and buying the market. And although it's come down 39% this month, it's still historically expensive. The average of all time is 18. In the last decade, it's actually been lower than that. So I don't get too cautious of the euphoria or the complacency until it drops below 15. And what I said to Liz is, while we might have a little bit of air turbulence and may hit a couple air pockets, you won't have to put on the oxygen mask. And I think that's a good way to capture what's happening right now. The other thing that we talked about was the short-term voting machine versus the long-term weighing machine, one of Ben Graham's favorite quotes. That's Warren Buffett's mentor. And that's what we're dealing with right now is the short-term headlines of shutdown and restrictions versus the long-term fundamentals of potentials, the lagged effect of the stimulus that's already in the system globally, 12 trillion of fiscal, 7.5 trillion of monetary liquidity, so close to $20 trillion of stimulus. To solve a $3.6 trillion GDP contraction. There's always a 6 to 9 month lag until that really starts to be felt in the economy. And so we're just in this kind of no man's land, like purgatory right now, because growth's slowing a little bit because you're having some regional shutdowns, which we're going to talk a lot about on this VideoCast podcast. But the vaccines are going to be kicking in weeks. So Pfizer just applied for emergency approval today, which usually takes a few weeks. And within a day later, everything's made, everything's ready to go. People will start getting vaccinated a day after they get that emergency authorization approval, which could be as soon as, early December, mid-December, we'll have people getting vaccinated. And something like 20 to 40 million people between Moderna and Pfizer, probably by late December to mid-January. And then by the end of Q2, it's estimated that we found out this week, it's estimated because the logistics has been pre-planned, because the dosages have been made ahead of time, risking that they would have lost everything if they didn't get approved, that 100% of our population will be able to be vaccinated by the end of Q2 and potentially sooner. So that's very, very exciting. And that's what the market is weighing in the short term. a little slowing of growth from regional shutdowns and the short-term case spike. But in the intermediate term, which is like very, very quickly, you have the lagged effect of the stimulus, you have the vaccine, you have the global pent-up demand, you have earnings growth of 22%, you have GDP growth that's going to be close to 6% because you've had 25% of M2 money supply growth year on year, and usually about a fourth of that translates into GDP growth. So that's the push-pull. And you see it on a day-to-day basis, as you saw the shutdown of the schools in New York. That caused the market to sell off a couple days ago. You had Chicago the day before that. Now you're having some restrictions in Philadelphia. And we know the roadmap. We know which cities are going to be shutting down. And we'll talk some more about that in this podcast VideoCast. The other point that I covered, because Liz always wants to get a trade for her viewers, and I pointed back to, we were on her show the Friday before the election. I believe it was the day before Halloween, October 30th. And the Dow was down 800 or 900 points at that point, just as I was going on. And I said, Liz, this is a rotation, not a liquidation. It felt like a liquidation. People were getting really nervous into the election. And we said at that point we wanted to get involved in banks. We wanted to be getting exposure into the weakness in banks, defense stocks, and energy. And since that date, banks are up 24.5%. Defense stocks are up 26.5%, and energy's up 34.5%. We continue to like that theme for the next 6 to 12 months plus. And on the bank side, Wells Fargo, Bank of America, Citi, we've now got a ton of Wells Fargo and Bank of America calls that were out of the money that are now in the money or at the money, that will probably wind up, that have a good amount of time on them, that will probably wind up exercising and holding the stock for the long term, because these are going to be, certainly in the case of Wells Fargo, doubles over the next year or two. Bank of America, same thing, and also Citibank is another one we like. On the defense stocks, when we were on, we talked GE and Raytheon. You can buy the defense stocks ETFs for that, ITA or DFEN if you really want to juice it. And then energy, you got to go the highest quality, ExxonMobil, and then we also put a midstream Kinder Morgan in there as well. And that was the theme of the segment. The rotation is real. We continue to like the same theme. We've been consistent with our message, and now we're getting paid, and we're seeing that come to fruition here in a major way. And then you've got the two historical tailwinds behind it. Cyclicals outperform statistically the first 6 months of after an election, and cyclicals relatively outperform the first 8 quarters or so of a new business cycle, which we're in. How do we know? We had 2 quarters of negative GDP growth, Q1, Q2, and then we just had our first quarter of positive GDP growth in Q3. Today, there was a note out by JP Morgan calling for a negative GDP in Q1. I think that is just an analyst reacting to the short-term emotion of these shutdowns. I think the pent-up demand is real. I think if we see 20, 30 million people vaccinated by the first few weeks of January, and there's probably, you have to keep in mind, there's probably another 30 to 50 million people with antibodies that don't even know it. So, right there, you're certainly well below herd immunity. But what you're going to see, because of all the people with antibodies and vaccines, is despite the fact we'll be dead in the middle of winter, you're going to see the case count plummet. When the case counts plummet, people are going to start to talk about herd immunity. Everyone's going to get excited. And by the way, the other thing that's the most important thing, I know a lot of people were afraid people wouldn't take the vaccine. When you now see Pfizer re-upped, now they're at 95% efficacy. I'm sure Moderna will come back and say, no, we're at 95.5. And then Pfizer will come back and say, no, we're at 96. The point is that, the average flu vaccine is like a coin flip. It's been between 29% and 50% efficacious for the last handful of years. Usually, the guess is it's going to be 50%. It's been worse than that the last handful of years. So to take a new vaccine that, you had less than a 50% 50% chance of working and, potentially, undesirable effects, now to see that it's basically 100% chance of working and it just deals explicitly with the spike protein, I think pretty much everyone's going to take the vaccine. I could be wrong, but enough people will take the vaccine, plus the people with the antibodies, that the case counts are going to just absolutely plummet by January, end of January, I would say, assuming everything goes according to schedule. And with that, the global pent-up demand is just bursting at the seams. We're seeing it in China because they're a couple of months ahead of us, and that's before the vaccine. Now, there was an article out that 1 million people have already been vaccinated with their China vaccine so far, that's very small numbers. So they've effectively had a full recovery to pre-pandemic levels before the vaccine. We're seeing that economically. You add the vaccine, you get velocity of that $20 trillion we discussed, and we're just going to be off to the races. So yeah, you might have day-to-day stuff where you get these cities, which we're going to talk about, shutting down. There's a lot of nuance behind these shutdowns, and we're going to go into it and delve into it carefully. So again, thanks to Liz Clayman, Jacqueline D'Ambrosi, Scales, and always Ellie Terrett, who was out this week, out on Thursday, for having me on. Moving on to the other thing I wanted to just make a note of here. Liz Clayman put out a tweet this week. You can follow her at Liz Clayman, LIZCLAMAN, on Twitter, and she said, "How can your heart not fill to the brim with admiration for my friend and hero, Staff Sergeant Aaron Hale, blind and near deaf from an IED. That's a bomb. We gave him a mortgage-free custom home where he started EOD Confections, which is a business that he handcrafts these chocolates and fudge. We ordered boxes of it this week, by the way. We're going to try to use it for a lot of Christmas and holiday gifts and support this business. But also, she put this link, so many more need our help. Join Liz's army. So go to Twitter at Liz Clayman. She put a link in her profile, and I clicked on it. And it just takes you to the website where you can donate whatever you feel like donating to help veterans that have been injured to get these homes. And I think there's no greater charity than that to take care of the people that have protected our defense and freedom and done all of that. So I definitely took advantage of that, and I encourage you, to whatever extent you're able to, go ahead and click on that link and donate and help the veterans and get them into houses. Okay, moving on. On Monday, I was on Cheddar TV with Kristen Scholler. I want to thank Kristen Scholler, Francesca Conti for inviting me on the show. Also, Cara Fellows and Taylor Craig for supporting Francesca and getting it all organized to get me on and get it all set. So this was a much longer segment. We covered quite a bit, much of which we covered in last week's VideoCast. So I'm not going to go into as granular detail because we've covered a lot of it, but just to do a few key things that I wanted to focus on. Obviously, the vaccine flipped the switch for the rotation that we covered from growth to cyclicals, in large part in terms of relative outperformance, not zero sum. We've covered that many times. Energy had its best week ever. It was up 16.3% going into that interview. Financials was the second, and value outperformed growth by its widest margin since 2001. So, the key thing going into 2021 is that I think earnings are conservative, and there are a couple other strategists that have come out saying the same thing. David Kostin over at Goldman thinks that earnings for 2021 are going to be 175. Jim Paulson out of Luthold said 200. But they don't really go into why. And I spent a little time on that with Kristen, talking about upward revisions and how, as people get vaccinated and that pent-up demand comes in, what's going to drive the upward revisions to earnings that's going to support the higher valuation in the stock market that you're seeing. From now, Morgan Stanley took up their price target to 3,900. Goldman was out last week taking their 2021 price target to 4,300 and 2022 up to 4,600. And the way that I see it is that I think banks are going to play a critical role, because while you've seen banks up 24%, 24.5% in the last couple of weeks, defense stocks 26%, energy up 34%. Tech was only up 11.5% during the same period. And the reason is they're expected to grow at a slower pace than the S&P 500. S&P is going to grow at 22%, give or take, and tech's going to grow at less than that, whereas financials, industrials, materials, energy are going to grow at that rate or much faster. So where we want to look for the upward revisions is in those sectors that are going to perform in line or faster than the S&P, not the ones that are lagging behind because they pulled a tremendous amount of growth forward during coronavirus, which is commonplace among communication services and among infotech. So there are two reasons that banks' earnings are underappreciated and I think are going to be upwardly revised very, very quickly. Number one is for the industry. I talk often about the top four banks being over-reserved by about $20 billion in my view. But the industry as a whole is set aside $110 billion of loan loss provisions in Q1 and Q2. They did that in the context of people were expecting 20% unemployment. Unemployment is now at 6.9%, and we saw this week that despite these mini shutdowns, and we'll have some short-term initial claim spikes, the unemployment rate is at 6.9%. So it not only didn't go up from 14.1 to 20, it actually cut in half from 14.1 to 6.9, but they have not yet released all of these reserves. And I think when all is said and done, they're probably going to release about half of these over the next 8 quarters. And no one's talking about this right now, but just stay tuned. So if you think about, I just want to do rough numbers, and the analysts will chisel it down to perfect numbers. But if the market cap of the S&P is about 23 trillion, and you're trading at about 21 times forward, give or take, so let's just call it $1 trillion some odd dollars of earnings for the S&P, probably a little bit more than that. If you just on the reserve releases, forget about the yield curve is steepening and the demand for housing and 85 million millennials buying houses and starting families and all those things that drive banks like crazy. Just if they released half of the reserve, the credit reserves, and they may wind up releasing more than that because stimulus could be coming quicker than anticipated, and we're going to talk about some developments that happened today. But that's $55 billion of earnings. That's not yet factored into the S&P 500, so that's a 5% pop there. Then you have net interest margin that's going to increase materially because of the yield curve steepening on a lagged basis, because banks will then be incentivized to lend. Obviously, you get 20, 30, 40 million people vaccinated over the next 8 weeks from now, maybe 10 weeks. You're going to see the case counts plummet. You're going to see people go back to work. You're going to see demand pick up for everything, for travel, for energy, spending. Everything's going to come together all at once. And this is not yet priced in because no one anticipated the vaccine, one, would be this efficacious, and two, would come this quickly. And I think people have dramatically underestimated. They're beating this drum well, yeah, maybe you'll get the vaccine, but you still have to distribute it. That's been put in place. The military has been put in place. And if you're underestimating the military, just think how quickly they put together hospitals and field hospitals in New York City overnight when they needed it. They put together so many so quickly that Governor Cuomo wound up not using any of it because there was just so much that they got done in such a short period of time. So the leadership has prepared. This distribution is going to be quick. It's going to be efficient. They'll spotlight some bad situations where people are confused in the short term. But I'm telling you, the minute you get the emergency authorization, within 24 hours, people are going to be getting vaccinated, starting with hospital workers and those most vulnerable in the older population. And then from there, everyone's going to get it. And it's going to be fast. It's going to be furious. And people are going to be so excited to get back to normalcy. So banks are going to be a major factor. The other major development was Boeing, the ungrounding of the 737. Now, I want to put this in context in terms of earnings. Boeing's still projected to lose a couple bucks next year. They lost $10 a share, give or take, this year. Let me just see if that's still accurate. Okay, so now they're only going to lose $9 this year, and they're going to make $1 next year. Okay, so they've taken it up a little bit, so $1.50. Okay, I want to put this in context. The first full year before they had this problem with the 737 MAX was 2018. They earned $17.86 a share. Okay, so I think that, number one, the 737 MAX has been ungrounded sooner than people expected, number one. Number two, I think people are underestimating the value of a 94 or 95% efficacy ratio of a vaccine that's going to cause such a demand for travel in such record time that people are going to be blown away. I mean, I'd hate to book a trip to Italy this summer or this fall. It's probably going to be like 5 times as expensive as it was a year and a half ago. We were actually booked to go to Italy in February, and we had to cancel our trip because they all started shutting down. But, anyway, it is what it is. So it's going to probably cost us 5 times as much in next summer, so no big deal. Nonetheless, So I think you've got 2 catalysts for earnings that are not priced in. Number one, I think you're going to see $55 billion for the banking sector come back. I think the net interest margin is going to dramatically improve profitability and incentivize banks to extend credit, which is going to further support the recovery. So banks are going to grow earnings, and I think Boeing is a huge weight. And if you get back to, even if you don't get back to double digits in 2021, which is probably too ambitious, if you start discounting $20, $25 a share earnings in 2022 or 2023, that is going to be material. And that's how these type of price targets can be fulfilled moving forward. Short-term headwinds we talked about. Retail sentiment still a little elevated. The AAII, we'll talk about that. Obviously, the short-term spike in cases. It seemed like it spiked 6 days ago, November 13th. I think we spiked above it today. But again, the vaccine is coming. We just have to look through the short-term noise and these, short-term shutdowns, which there's a lot behind these shutdowns that we're going to explore. The intermediate term outlook, which we covered with Kristen, easy money in the short term has been made in the general indices, but is just getting started in the cyclical and value trade. I think it's going to be a better trade than having even bought the indices in March and April when we wrote the Spanish flu article on March 18th, and the market bottomed on March 23rd. I think there's more opportunity today in the cyclicals than there were in the general indices in March. That's how promising this looks. So we've been saying this for many, many weeks. You can review all of our podcasts at hedgefundtips.com. Just scroll down to the right and you will see category VideoCast Weekly Recap or podcast. You can watch them there. And we also covered the 8 catalysts for growth looking through the short term, which we've gone through. The vaccine, divided government, that's huge. That the Republicans hold the Senate in Georgia so that the corporate tax rate stays at 21%. That will continue to have a positive impact on earnings. If that were reversed to 28%, that would not be good. Odds favor that staying status quo. That's a huge driver. Policy uncertainty should come down in coming months. V-shaped recovery is on track, 5 to 6% GDP in 2021. Upward earnings revisions, again, that is the key theme. That's what's new this week. You want to be on alert for upward earnings revisions. And the S&P earnings were actually upgraded again this week, which we're going to talk about at the end of the call. Accommodative Fed, they're going to keep the short end pinned. The long end will do what it does, which is steepen. That's very positive, both for bank earnings and for credit expansion. Yield curve steepening and stimulus. We're going to get stimulus. We just may be getting it from a different source that we didn't anticipate, and we're going to go in detail with that. The other issue that now supports the rotation is that there's no scarcity of growth. So in 2020, managers had to bid up growth because that was the only place, a handful of stocks and then some ancillary SaaS stocks, where you could find growth in a slow growth economy. We're now moving into a fast growth economy, which means there's a plethora of options for managers to buy earnings growth, which means the multiples on the concentrated stocks that made up the greatest weight of the indices, FANG plus SaaS, all the stay-at-home stocks, those multiples are going to normalize and come down to earth, whereas the cyclicals are going to start to raise multiples because earnings are going to rise. They're economically sensitive, and they do best in the early part of the cycle. So thanks again to Kristen Scholler and Francesca Conte, as well as Kara and Taylor for having me on Cheddar. Moving on to Reuters on the 16th, which I think was Monday. I want to thank Meta Singh and Shivani Kumarasan for having me in their article. The quote was, this enables managers to now more broadly expose their portfolios to new pockets of growth. You could potentially have a bit of profit taking in the morning, but on balance, there's not much to sell in this news, in the fact that most managers went into the election flat-footed, and now they've got to play catch-up into year-end. So that still holds. I do think there's going to be a real catch-up trade. I do think managers were too defensive and flat-footed, and I know, based on the price of insurance, there was demand for it, which means they were underweight, which means they got to catch up or find a new career. So then on that night into the next day, Chibuke Ogu and Alun John. I want to thank Chibuke for having me in these two articles. And my quote was, this is a continuation of what we saw last week with the vaccine being the catalyst for a rotation into cyclical sectors such as energy, financials, and defense stocks, with expectations for renewed demand and travel. And the light switch has really turned on, and this is the real deal, unlike some months back. So when we had that fake rotation in May into early June, that collapsed when cases spiked back up, and we had the rotation from the northeast to the southwest, and cases spiked, and cases are going to be squashed. 94% efficacy. It's weeks away. This is very, very exciting. The process begins weeks away. And then the next quote was, this is a continuation of what we saw last week, the vaccine being the catalyst. Okay, so we got that. And then last night, Chibuke Ogu, thank you again. And I said, a meaningful stimulus package will aid some small companies, the underlying economy, as well as the unemployed and the people most at need. And there might be less of an inclination for cities to shut down once the stimulus is done. So that is very nuanced, and we have to kind of unpack that in the next few minutes as we move into this, because I was very concerned that a lot of cities were going to shut down. I think there's a lower probability of that now based on some actions that Secretary Mnuchin took in the last 24 hours. So we'll see. Now, the other trend, we said, number one, you guys, to focus on upward earnings revisions. That's going to be a key theme going into 2021. Number two, opinion follows trend. We talk about it every few weeks. This is key. So now you've seen this huge move since that Friday before the election in this rotation into cyclicals. And now every single article is now talking about getting into cyclicals. So opinion follows trend, and now they're starting to get interested after a 30% move. They'll get really excited when they break out to new highs and they've missed the first 100%, but that's okay because there's probably another 100% behind it over the next few years, and that's just the way it always works. So in this article, this is a Barron's article by Aaron Barry. He lays out the year-to-date performance for the different pockets, and this is where the opportunity is. So the S&P was up 11% for the year, growth 28%. That, again, those are those weights that are going to now normalize and come off the boil. Value, Russell 1000 value negative 4.6. Let's see, and Russell 2000 value, that's small cap value, negative 9.3, and Energy Select XLE negative 42.6. So that's where you're going to see your value. It's almost like the dogs of the Dow, where you buy the 5 highest yielding Dow stocks at the end of the year, the ones that perform the worst, and then they outperform in the next year. So what's last becomes first. And we have the same thing here. So if you want to know what's going to do well in the next 12 to 18 months, it's likely those things that lagged a bit behind. Again, energy, financials, and defense stocks. We like those three aggressively. And that's basically the case that he's making after they're popped up, 20, 30% off the lows. Morgan Stanley, as I said, upgraded their 2021 target to 3,900. Goldman was at 4,300. Next, we have AstraZeneca came out today. Their vaccine produces strong immune response in older adults. So that's the AstraZeneca Oxford. So more and more, which means we're going to have more and more supply, probably more than the 40 million doses we're expected to have by the end of the year between Moderna and Pfizer. So if AstraZeneca comes on board, then we'll get probably an announcement from J&J. And my guess is that J&J will be 95.1 or 95.125% efficacy. They'll all be like 10 basis points better than the next. The key is they're all looking great, which is the most important thing. Moderna's data came out better than Pfizer, and then Pfizer came back and came out better than Moderna. Eli Lilly got a treatment approved very quickly for emergency use approval today. Yesterday, rather, they had an arthritis drug that helps with, combined with remdesivir, for treatment in adults and children who are hospitalized and require supplemental oxygen. So those are the most severe people, and also the people with on ventilators. They're basically at the brink of death. You give them remdesivir, you give them this other pill. WHO came out with a hit piece on remdesivir. They've been wrong about everything. So I would just leave that aside. This is very positive news from Lilly. As we covered, Pfizer requested emergency authorization approval today. So hopefully in the next couple of weeks they'll get it, and then the vaccinations begin. Boeing's back on track. We covered last week that this is also huge for not only Boeing, but for the airlines, and it's huge for GE, and that's one that we've loved, and that's going to continue. So here again, opinion follows trend. Another article by Steve Goldstein in MarketWatch. Fund managers have hopped on the rotation to value trade. Latest Bank of America survey shows, which we're going to cover that in detail, and that's what's happening. Next, OPEC sees the oil cut extension curbing the 2021 rise in oil stocks. So they look like they're going to extend for another 3 months at the 7.7 before moving down to 5.7 barrels a day cuts, which will extend all the way through April 22. So that's a positive for the energy sector. Occidental Petroleum actually finally got upgraded from Susquehanna. Again, he says it's time to buy. Opinion follows trend. So that stock was up. And you're seeing the upgrades now. So after they have the big moves, then everyone jumps on board. Here's a good article from Carlton English over at Barron's. There's still time to buy the regional banks. 5 stocks to grab now. Now, to Carlton's credit, she's been ahead of the curve on banks. She was early in the summer, but it's perfectly fine because they've continued to appreciate since then. And I give her credit because she was one of the few journalists to get out ahead of the curve and get people positioned before the huge bounce. And as she says, there's still huge opportunity in the sector. Next, again, put bank stocks in the buy pile if you think the corona vaccine might help the economy. If you think the corona vaccine will help mend the economy, you think, I don't think that anything could be more of a catalyst to help the economy than a vaccine with 95% efficacy. So this was a great article by Philip Van Dorn over at MarketWatch, and he just laid out the case. And he did a good screener here. The KBW Bank Index, which is KBE, I think is the ticker. And he sorted them out by price to book, with Citi coming in at the low end, price to tangible book, Citi, Wells, and CIT. CIT is more of a lender, like a small business lender. And that's, we like Wells Fargo, we like Citi, and we like Bank of America. Is not trading at quite the discount, but it is still a quality franchise, and you can see he also has listed the dividend yields, etc. So tremendous amount of opportunity. And again, opinion follows trend. As the price goes up, more of these articles, more of these analyst upgrades, which is going to force more of the institutional money in, and then you're going to get the reserve releases coming in coming quarters. People are going to start to pay attention that stop looking at the absolute value of the 10-year yield and start looking at the spread, which we've covered every single week for the last 3 months, that it's now 5x, that 210 spread. That's what you want to focus on. That's where they, it's the difference between what they pay for capital and what they charge for capital, what they borrow at and what they lend at, and that's the spread. And if you look just a couple years ago, August 2019, when the curve inverted, that spread was 10 or 12 basis points, and banks were at all-time highs. So keep in mind, this is all of the stars are aligning for this sector, and now it's starting to become closer to consensus. And then once it's truly consensus, all the managers will chase into it because they're all dramatically underweight. And we're going to see that it's actually one of the most crowded trades in the institutional survey this month was short banks and long tech. And history will tell you always want to take the opposite side of a crowded boat, which is lightening up on tech as those multiples become normalized, and increasing your weight to banks as that short covering causes rip your face off rallies to the upside, which we started to see the beginning of in the last couple of weeks. Jefferies, here's another article, turns bullish through 2021 on financial stocks. So again, opinion follows trend. After the move, they get involved, and that's going to bring more and more money, more and more institutional elephants into the room. And he's pointing to actually what we've been talking about. He points to the $110 billion of loan losses, those reserves being released in forward months. So as this narrative becomes more ingrained and people go, light bulb hits, the money is going to chase. Again, new home, our big thing in late March and early April was pounding the table on home builders. So now you're seeing all the positive articles after they're up 100%. Everyone's now saying, I want home builders after they're up 100%, which means they're probably going to breathe a little bit before they take the next leg up. And then they'll catch the second wave of buyers, which is the breakout buyers. And that's fine because it's going to be a long-term secular move. And so new home construction surges to post-Great Recession high in October, driven by rise in single-family starts. So, and I think we got another number, existing housing sales. I think we're at a 14-year high this week. We'll go and look at that data before the end. So Citi got upgraded by Keefe Bruyette this week. Again, opinion follows trend. Price target $65. Wells Fargo got upgraded this week by D.A. Davidson. Price target $31. They're way under the curve. It's going to be much higher than that 12 months to 24 months out, but it's a move in the right direction. And it's a bold call right now because, again, that Apple was the most loved stock. We did the article in April. Apple was the most loved stock in the S&P when it was at 130. Then it traded down to below 120, down to I think 103. It's been in a short-term downtrend. And Wells was the most hated, and now it's starting to move big time the last few weeks. This is a bold call by Tom Lee over at Fundstrat. I like his stuff. He's calling for a 7% surge into year end. And he laid out these 10 reasons, which is interesting. This article came out yesterday. It's basically 7 of the 10 reasons that we covered on Kristen's show on Monday, and then he added a couple other interesting ones. The vaccine, he makes the distinction that policymakers are pushing for soft lockdowns versus killing the recovery. Let's hope that continues. I think closing the New York schools was a little heavy-handed and unwise because it forces parents to stay home and it disproportionately hurts the poorest people. Pent-up demand is the U.S. Look at the output gap. That was a good point. China is seeing massive explosive economic recovery. We've been covering that every single week with our CGTN spots. And fiscal stimulus coming. We'll talk about that. 4.5 trillion of cash on the sidelines. I'll show you some charting on that. And Santa Claus rally and the Fed is dovish. So we talked about the Fed already. This is from Sentiment Trader over at Twitter, at Sentiment Trader. This is a great chart. Everyone's complaining about the VIX being so elevated, but in effect, this is the beginning. It hits these levels at beginnings of new cycles, not at the end. It would only join. It would join only April 2003 and October 2009 as ending streaks this long at this elevated of a level. So again, it spiked to 40 and now it's coming off the boil. It's down in the low 20s, but that happens after huge spikes, and that starts the beginning of new cycles. So what's interesting here is in October of 2009, you'd already had a monster, 40, 50, I think 600 to 1200. I don't know. It might have been close to 100% rally because the S&P got to 666. I don't know if it got up to 1200 by the summer, but people were like, oh, now we got to take the second leg down. We're up 100% in 6 months or whatever it was, 80%. It's similar to the type of rebound we've had here. And yeah, they got this little pullback in it. First off, it kept rallying after October 2009, well into 2010, and not until 2010 did you get the correction in the fall. And then, it was just the beginning of the bull market. So same thing in 2003. It was the beginning of the long-term bull market. And I think we're in the same exact situation. Even if you get this noise like you get after that first big run, you get these kind of breathers after the first big run. So that was a really nice chart from Sentiment Trader. This is a guy named Macro Charts, Macro. I like this because this has kind of been my template also. If you've seen my CNBC Indonesia when I'm talking about a long-term commodity cycle and emerging markets and a weakening dollar, the template has been the early 2000s, and he put these charts side by side. This is the XLE, which is the energy sector, and he kind of showed how it's breaking above, the 200-day moving average, and it looks exactly like that trend in 2002 to 2003, which was the bottom of a 6-year monster commodity cycle led by energy. And I think we're coming into the same thing. And people are like, well, how could you say that if President Biden is the new president? Isn't he all about green stuff? Yeah. He's going to make it harder to drill, which is going to cut supply, which is going to make the big companies bigger and more profitable. The marginal players are going to go bankrupt, and the price of oil is going to go back up to $60, $70, $80 because We don't have enough renewables yet. We will in 10 years, 15 years, 20 years, no matter how fast the Green New Deal gets implemented or if it gets implemented. But in the short term, it's going to be a bonanza for the big energy players, and we're going to be back at $3, $4, maybe $5 at the pump in the short term until the renewables kick in. So that's extremely bullish for energy. And this setup is exactly the same as the early 2000s. And I think this is going to be a secular move for the next 5+ years in commodities and energy, and start with the highest quality and then work your way down. Jury and Timmer over at Fidelity, at Timmer Fidelity. You can follow him. He put this out. Small cap value stocks are catching up to large cap growth stocks, both on an absolute and relative basis. In other words, market leadership is broadening out, which is consistent with early cycle bull market. Early cycle bull market. That's the key thing. And you can see here in brown, this is the Russell values spiking up like crazy. And the Russell growth is starting to slow down. And the S&P is right in the middle, which is a combination of growth and value. Sarah Ponczek, at SarahPonczek. She's at Bloomberg. She puts out some great charts. I definitely follow her. Strongest 11-day rally in the Russell 2000, which is small caps, up 15%. For small caps, this is the biggest rally since 2011. So this looks huge, right? Except it did the same thing in 2011, and then maybe you had some short-term noise where it consolidated sideways, but it was the beginning of a multi-year long run. Same thing in 2015-16. It did a similar type monster move, takes a little break, and then it just continues for multiple years. And I think we're again in a similar phase with small caps there. David Keller. I thought this was the greatest chart of the week. He works for stockcharts.com and D Keller CMT on Twitter. And I love this because everyone was saying, we're at 90% of S&P stocks are greater than the 200-day moving average. We're overbought. We're going to crash. And he made the point that while it sounds frothy, it usually happens after major lows and leads to much further gains. After major lows means the end of an old cycle, after the crash, the beginning of a new cycle. You get these monster moves from you get down to like 5% above the 200-day moving average, or in some cases you get as low as 1 or 2%, like you did in 2009. You get that abrupt thrust above 90, that first thrust. And you see here, this is the S&P. It does, rest for a month or two, and then it continues the 4-year cycle, even after such a momentous move. Did the exact same thing in late 2009, which is also consistent with that October 2009 chart, which we just covered, the same exact period. And yeah, you rallied more, then you had to pull back into 6 to 9 months later. We'll probably have one of those maybe fall of next year, and then you continue the uptrend for secular trend for multi-years. And we have the exact same setup right now, where we had this huge monster. We've rested for a couple of months here, chopped sideways, and now we can probably make a little bit more move before we get a bigger rest sometime next year, mid-year, probably after all the good news is priced in, and then we have to look forward to 2022 earnings and see if they're going to sustain, which I think they will given the amount of money in the system. So great chart by David. And then this lady, Callie Cox, she put out this chart of the S&P's average path in all years since 1950. This is just a composite of the general market performance, cyclical, seasonal market performance. And she talks about the pink arrow shows where we are right now, November 19th. So this was yesterday. And that's exactly what we've had. We kind of had this huge shoot up off the election, then a sideways consolidation this week to close down, and then that 7% rally that Tom Lee's looking for at Fundstrat would match the average performance. It doesn't mean it's going to happen this year, but on average, you do get this strength into year end and I think this year more than others, managers are really going to be forced to chase because they were flat-footed into the election drama. So this could be very, very positive. That's Callie, Callie, Abost. Great chart, Callie. Okay, this week, by the way, for those of you on the podcast, you will get cut off in 10 minutes. We might get through it all in 10 minutes, but probably not. In which case, go to hedgefundtips.com and you can watch the VideoCast. Either just scroll down here on the right side and click on VideoCast Weekly Recap. By the way, I put this button here. Follow us on Parler. I'm going to try it out. I watch Maria Bartiromo's show. She's big on Parler. I'll see how I like it. I'm kind of a centrist, but I could almost be an independent, but I'm going to do it just because it's growing like a weed and it's just one more place that I can put out my ideas. If you want to follow me there, you can follow me there. I don't know if I'm going to stay with it or not, but I'm going to definitely test it out. I'm on basically everything from TikTok to Parler to Twitter to Instagram. We put out our content everywhere, and that's just one more place to go, and we'll see how that goes. So it's not making any type of statement other than the fact a lot of people are there, and we'll send them the information and see how it goes. Okay, so here we are on the November Bank of America Global Fund Manager Survey results. This was the first month that you saw in earnest a beginning move into cyclicals and staples. So they started to believe that small caps were going to outperform large caps. That's a sign of risk on. They started to move into emerging markets. They started to believe in value will outperform growth. This is all new in the last 30 days. And they started to get a little bit of exposure to banks despite believing that banks was the second most crowded trade. So there's this transition period, this purgatory position where they're coming from hell. They're in purgatory, they're moving to heaven, and that's the trajectory of banks. And even energy started to get bid, so that was good. And then they started to move out of defensives like staples. They started to move out of cash. They started to move out of bonds, move out of healthcare, etc. So that was positive to see. This was, again, a couple hundred managers with over $500 billion of assets. Growth expectations are at 20-year highs. Most people pointed to this chart like it was bearish. This is bullish. The last time this happened was March 2002, which was the beginning of a 6-year bull market. So this is absolutely bullish. Again, this is one of those things that goes extreme off the first move. Happened again in mid-2009. All of these are pointing to the same thing. Yeah, we've had a huge run off the bottom, and we may go consolidate sideways for a little bit, and it's just the beginning of a longer-term business cycle. So that was really good. Profit level expectations are also at the highest since March 2002. Again, of course they are. They're so low this year. Of course they got to get better. Now, this was one of the most important charts, I thought. The yield curve expectations were at all-time highs. If I didn't mention it, all of this is from the Bank of America Global Fund Manager Survey. That's the source of all of this. Now, the last few times that yield curve expectations got this high, meaning net percent expecting a steeper yield curve, every single one of these last 3 times, this is the 4th time, banks had monster rallies, and we're going to talk about that in the article of the week. What asset classes do you think will outperform in 2021? The top 3 listed were emerging markets, S&P 500, and oil. Oil is new. That's really, really positive to see. That's a sign of confidence in cyclicals. Cash levels started to come down. People pointed to this as a very bearish thing because they're looking at recency bias, which was in February of 2020. You got cash levels this low right before you had the crash. And that's the purest definition of recency bias. The difference between that and this is we're coming out of the coronavirus, not going into the coronavirus. And the last time you had cash levels that were way lower than this even, which would be more bearish, was what? After the huge rip off the 2011 lows, cash dropped, managers chased, again, right into year end. And it was the beginning of a 3-year bull market into 2015, 2-year bull market into 2015, 2016. Let's see, wait, 1, 2, 3-year bull, 2.5 to 3-year bull market when after cash levels dropped this low. So yeah, you had the hiccups. Again, huge rally. This looks like an arithmetic chart because it's showing this is flat. This was very steep. This was as steep as this was. If it was on a log chart, you would see that. But this is the kind of cash levels that you see when people have to chase after they've missed this huge thing. This was an exception because of the coronavirus. So I think this is again pointing to those extremes that happen after those runs in the beginning of a new cycle. This was Fund Manager Survey positioning versus history. It still shows on balance they're still too underweight energy, they're still too underweight banks, and that's going to change. Small caps will beat large caps. That's a sign of risk on. That's a good thing to see. Same thing happened right in the early stages of 2009 after the 2008 crisis. And again, that was the beginning of a bull market. Most crowded trade we see here, long. So managers felt they're starting to feel less that long tech is the most crowded. That came down month on month, but it's still very high because why? Opinion follows trends. If you recall, we had a correction in FANG in previous months, but they went up and they started to feel that short banks are getting too crowded, which is good to see because these two are going to reverse. I think you're going to see massive short covering in banks, long banks, and you're going to see people lightening up on the overweight tech, which is very, very good position to be in. Biggest tail risk, COVID. That was pre-vaccine because this survey ended on the 12th. Tech bubble, civil unrest, a credit event, U.S.-China trade war. So those are basically the same every month in the last few months. And the contrarian trade, the Q4 contrarian bulls would position for a completion of the full bull reopen. Contrarian bears would go for a flatter. Okay, so that means that you'd want to be getting exposure into energy stocks, banks, etc., cyclical stocks. So Michael Hartnett, reopening rotation can continue in Q4, but sell the vaccine as we're close to full bull. That's interesting. So we did consolidate this week. I think they're getting a little too cute here because we've moved so much off the bottom and we're stuck in the recency bias. We're not stuck into, if you go through those 4 or 5 charts that I just covered, the behavior is much different off a new cycle bounce than a mid-cycle bounce. So new cycle bounce, you get that extreme move, and recency bias thinks you're going back down, but it's actually just beginning. So while we could consolidate, I wouldn't get too cute with this. This rotation hasn't even started. Now for the article of the week, the AC/DC thunderstruck stock market and sentiment results. I put this out the day after Mayor of New York decided to put 1 million kids out of school because the arbitrary positivity ratio hit 3%, despite the fact there have been absolutely 0 deaths. The problem, first off, I love this song from AC/DC, Thunderstruck. I'm not going to play it for you now, but I'd suggest you play it on your own time. Effectively, what this is going to do is it's going to impair their parents' ability to work, earn money, and contribute to the economy. And it disproportionately hurts students of lower socioeconomic status as they might not have the proper equipment, internet connection, or support system to keep up with their schoolwork remotely. And this is a disadvantage in their development years that will haunt them through their entire lives. You know, when you're older, 6 months, it's like, oh, it's no big deal. When you're between 5 or 3 and 15 years old, you miss 6 months of school, you're toast. You don't ever catch that opportunity back up in the right way at the right time. This is a huge mistake. And the stuff just doesn't get delivered. That's why, you know, everyone does pods or they do explicit homeschool or tutors that can afford to, and the ones that can't really get left behind, and it's not a good thing. So what's going on here is there's a subtext going on in these regional shutdowns, and they're targeted to those areas that are in desperate financial situations even prior to COVID hitting. And you'll see that city by city, you can almost track it to the worst financially structured cities prior to COVID are the first ones to shut down. And the subtext is, we don't have the money to properly keep schools open with the virus. So if you'll just pass a $3 trillion stimulus package, we can reopen properly. Now, some of that stimulus money will go to equipment for the schools and ways to keep it open. But the majority of the money in the $3 trillion that they're asking for is going to unfunded pension liabilities. And that's really just been the crux of the disagreement. Because if you look at how much do we need to save small businesses with another PPP, it's about $100 to $150 billion could save millions and millions of jobs and put millions and millions of people back to work. How much is another stimulus check if you wanted to give everyone $1,200 again that needed it? It's about, I think, maximum $300 billion. So now you're at $450 billion. Then you give $25 billion to the airlines, another $25 billion to hospitals. You're at $500 billion. Well, guess what? Secretary Mnuchin just came up with the money for you, because what he said was, I'm not extending the municipal lending backstop for the cities, and I'm not extending the Main Street lending program because it wasn't being used. Give me the money back. It's $500 billion. Give it back to the Treasury. And he called on Congress this morning to, Congress has to approve the reappropriation of that already authorized and accounted for money, $500 billion, to put towards PPP, put towards stimulus, put towards the bailout. That would cover 100% of COVID-related expenses. And this changes the game because there's no excuse for them not to pass it. So if they don't get this money out to the most needy people tomorrow, they're effectively saying, we don't really care about the people. We care about the full package, which is $3 trillion, so that we can fund pre-existing pension liabilities. And that's really going to hurt a lot of people who need the money now. And my position, which now became crystal clear today with Secretary Mnuchin moving ahead with this move, is that get the people who need it the money. And if the $3 trillion is so important, you can do that. You can go for a bigger deal after the Georgia runoff. I mean, it goes to the old saying, to the victor goes the spoils. I mean, effectively, House leadership, and this is not political. This is just money. Okay, this is a stock market podcast. They made a bet that they were going to sweep, because that's what consensus was. They were going to sweep a blue wave election. They lost seats in the House, and they were expected to win the Senate by 4 or 5 seats. They lost the Senate so far. And they won the presidency, it seems that way. Okay? So everything points to that. So basically now you've got divided government, blue president, red Senate, blue House. If they had gotten the blue sweep, they could have $3 trillion, they could have $5 trillion, they could have as many trillion as they want. Okay? They didn't lose. And to the victor goes the spoils. So what happened prior to the election was the Republicans, or the Senate leadership, wanted to get a deal done. They were at $500 billion, like they are now, to $500 billion to $1 trillion. They were desperate to get a deal done before the election, so they bent over and they basically gave the House leadership everything they asked for. The House was at $2.2 trillion. The Senate was at basically $500 billion, and the Senate bent over, and the administration bent over, and they said, fine, we'll do $1.8 trillion. $1.8 trillion. And that was way more than splitting the baby. And the House leadership wouldn't even come down to $2 trillion, never mind $1.8 trillion. They were basically getting 81% of everything they asked for. They didn't do it because they gambled on the fact that it would be a blue wave and then they could get 2 or 3 trillion, and they lost. So now, rather than having gotten 81% of everything they could have asked for and bailing out quite a few of those pensions, unfunded liabilities, and the Green New Deal, and basically everything they wanted, plus they could have done another $1 trillion after they won. Now they're effectively getting nothing. They'll be lucky to get the $500 billion to $1 trillion because the Republicans hold the Senate, and we don't need more than $500 billion, and Secretary Mnuchin just found the money. So we could do the $500 billion tomorrow without costing taxpayers one single penny, and there's no legitimate justification for saying no. If you say, we want to do the Green New Deal, and we want to shore up all these cities' finances that were in trouble before COVID, you can do that. You just have to win. you didn't win yet. Now, you could say, all right, we will reappropriate the $500 billion, and then after we win the Georgia runoff, then we'll do another $2 or $3 trillion. And if you win, you can do that. To the victor go the spoils. But right now, there are just too many people hurting. There's a fiscal cliff coming in at the end of the year. All the unemployment's going to run out. Extended unemployment, the student loan moratorium, the eviction moratorium, the foreclosure moratorium, every moratorium. And we're in this position because they couldn't take yes for an answer. I mean, if someone offers you, when you're negotiating, if you want one and the other wants two, you say, okay, let's split the baby. We'll do 1.5. No one's happy. And you move on and you act like adults. And that's the way deals go. The Senate was at 500. They came up to 1.8, down from 2.2. A real deal would have been, somewhere around 1.2, 1.3. They really bent over. They basically gave them the whole enchilada, and they couldn't take yes for an answer. So they lost. They don't get it. And in the meantime, Congress fiddles while the people get burned. And there's no excuse, and there are going to be political ramifications for that. And that was felt in the House. So you can continue along a path that hurt a lot of people and hurt your party, or you can do the right thing for the people, win, and then go get whatever you want. $2 trillion, $4 trillion for the Green New Deal, whatever you need. But this is insanity. And now that the money is available because of Secretary Mnuchin's astute management of the program, it's there on a platter. That's got to go to the people, and it's got to go fast. We're talking Thanksgiving time frame. That will be very, very constructive for the market. And then whoever wins the Georgia runoff, either that'll be it, or maybe the Republicans, the Senate will do another $500 billion to take it up to $1 trillion. We'll see. If there's some, cooperation, they get some of the things they want. The Democrats get some of the things that they want. That would be great. So you get the 500 now, you get another 500 in February, probably when everyone comes back. Or the Democrats win the January 5th and they do $500 billion now, and they do another $2.5 trillion, $3 trillion. They get everything under the sun. Be a double Merry Christmas for them. So either way works, but now there's no excuse to screw the people. Because the $500 billion's there, you don't have to ask for more money. All you have to do is approve the reappropriation of the money that's there. So, with that said, what Mnuchin has intentionally or unintentionally created is a similar situation to we had in August, when there was also this type of deadlock, and President Trump did the executive order from I forget which fund it was from, but I think it was from FEMA, from the Emergency Relief Fund, and he was able to do the extended unemployment till the end of the year for the people whose unemployment was running out, and it basically checkmated the opposition, because then a deal didn't have to be done because those people were covered until the end of the year. Now we're coming up on the end of the year, they're no longer covered, and all these other things are going to click off, and that's where we are. So what Mnuchin did today by getting the money back to Treasury from the Fed that's no longer needed, and by the way, they still have over $750 billion of firepower. So the article in the Journal and the article in the Times that kind of said it was a political move, or made municipalities or Main Street businesses vulnerable, was incorrect, because they have the ability to lever the remaining money up to $750 billion, which just hasn't been used. But if we get into a situation where growth slows in the short term due to shutdowns that they need it, there's more than enough there. And therefore, this $500 billion can go to work directly in the pockets of the people who need it the most. So, with that said, I think we're in an exact same situation now as we were in August, that it becomes a lower incentive for these cities to aggressively shut down and crush the economy, because the ones that were shutting down in order to force a big stimulus package to shore up their finances, now that they don't have the blue wave, and they may get nothing, even though they could have gotten 1.8 trillion just a couple of weeks ago after the Republicans and the administration bent over to do a deal before the election. They could have had 81% of what they were asking for. Now they basically get nothing. So they should take this $500 billion, because if they shut down thinking they're going to get a $3 trillion deal from a divided government, it's never going to happen. And the only people that are going to get hurt are the cities that are shutting down. They're going to take a tenuous financial situation and make it worse for themselves, because there will be no follow-on money. So by shutting them down, they put their own finances in more dire straits. And what's going to happen is they're going to start to get their bond ratings downgraded, and they're not going to be able to raise money. So there's no money coming from the Fed. Their bond ratings are going to get lowered. The municipal facility is not as robust as it was, and they're going to effectively bankrupt themselves with these shutdowns. So that's one way to go about it. The other way to go about it is take the $500 billion, hook up your people, maybe modest shutdowns, but no hard shutdowns. We'll probably see these cases spike. It looked like they spiked on November 13th. Maybe they didn't. So maybe it'll be a couple more weeks. But we saw this in the Southwest. They go parabolic, and then enough people get antibodies, and it just comes off the boil. I do think enough people are actually wearing masks that's not actually the critical factor. I think it's more the indoor stuff. Maybe there's a little COVID fatigue. But when all is said and done, they spike like crazy, and then they drop. And the same thing will probably happen here. So I think the shutdowns, and based on the cities that are doing it, so there's a pattern to those cities that are calling for the shutdowns, and this was pointed out by the Detroit News. Illinois, so Chicago shut down first on Wednesday, then New York shut down on Thursday. Connecticut, where I live, they are shutting down all sports starting on Monday. Fortunately, my two girls have a meet tomorrow. They're going to be able to book times this year, which is huge, because they're 1 and 2 in basically every stroke, which is awesome. And then and New Jersey's also at the poorly managed days, so they're doing the soft shutdowns. And on Wednesday, when I put out this article, I said I can tell you the cities that are going to close in the order that they're going to close. And it's simply based on their finances, which this article, it's called truthinaccounting.org. They rank each city based on their taxpayer burden or taxpayer surplus. So if there's a big red line, it means they're in a horrible financial situation, which means the taxpayer burden is the amount of money each taxpayer would have to contribute if the city were to pay off all of its debt accumulated to date. So New York City, they'd have to pay $63,000 a person. Guess what? They shut down this week. Chicago, $37,000. Guess what? They shut down this week. Honolulu, I don't know if they shut down this week yet, because they don't really cover Hawaii much on the East Coast, but my guess is some of it shut down. If not, it'll be next week. Philadelphia, they're already talking soft shutdowns. They're negative 25,000. And New Orleans is negative 18,000. They'll probably be doing shutdowns too. Why? Because if they feel like if they hold the economy hostage, it'll force Congress to give a $3 trillion package so they can pay off all of their pre-existing obligations. And it's just not going to happen. You had to get a blue wave to get that result. So it's not going to happen. Take the $500 billion, help your economy. Because if you hold them hostage, all that happens is you destroy your city, you destroy your bond ratings, and you get human flight and capital flight. And guess where all that capital and human capital and investment capital goes? It goes to well-managed states. In effect, the opposition. So you're effectively helping all the well-managed states that are probably of a different political persuasion. You're helping the opposition because all of your capital, all the investment, all the people are going to go to those cities that are well managed, because your city is going to go bankrupt if you hold the economy hostage, and there's no bailout coming, and there's no $2 to $3 trillion package coming with a divided government. Take the $500 billion that's there. If you win the runoff, you can do $2 or $3 or $4 or $5 trillion for the Green New Deal, but you got to win to get the spoils. To the victor goes the spoils. So I think now with the $500 billion, it's a checkmate situation like we saw in August. and the people will finally get helped just like they did in August with the executive order. Let's hope they get this $500 billion out to the small businesses that are struggling, the people who work for the small businesses, the people who are still unemployed. We've regained well more than half of the jobs that were lost, but we still have people that are hurting. And maybe there's a stimulus check in there for lower income people. They can bring those thresholds down. That would be a good thing. But if they keep this craziness on and they try to do these shutdowns thinking that they're going to force a big package, which is never going to happen. So here are the cities that are going to shut down. New York has already started. Chicago has already started. And I'm just looking at this chart of the ones from worst financial condition to best financial condition. Honolulu, I don't know if they're shut down yet or not, but I'm sure they'll be next. Philadelphia already started this week. So this week right now, the top 4 worst cities already started their posturing. New Orleans will be next, then Oakland, then guess what? Portland, then San Francisco, then Baltimore, then Pittsburgh, then Miami and Atlanta and some of these other cities. So it doesn't have to go this way. What you could effectively do with the $500 billion, you'd probably take this bad number down because you'd get growth back and you'd get confidence back and you'd get employment back. So take the $500 billion and, do everything you can to win in the January 5th runoff and get your extra 2 or 3 trillion you can bail out all these pensions. You can do a green deal till the cows come home, but you got to win. Take the free money now, win if you want more, or you got to win at the midterms if you want to do the huge packages. But the leverage was lost. You had that 1.8 billion. You couldn't take yes for an answer. Take the 500 billion, help those most in need. And then if you want more, you got to win. So that's that. Moving on, the stock market stuff we covered. Now here's some of the charts that show the rotation is real. Energy up 34%. We see that since the Friday before the election. Banks 24.5%. Defense 26.5%. Tech was only up 11% in the same period. The yield curve continues to steepen. As we talked about last week, this first check down, again, is always at the beginning of a long-term cycle. First check down, beginning of a long-term cycle. The green is financials. That continues. These are the fast-growing sectors. Next year, energy, industrials, consumer discretionary materials, S&P, and financials. The slow growers are infotech, consumer communication services, healthcare, consumer staples, real estate, and utilities. And that was the spike on the 13th. I think it might have gone back above that. And that's the way it tops. It did the same thing in the summer with the Southwest. But the deaths are relatively subdued, although, they're getting up there. So we just, obviously wear the mask. I think most people are doing that. But sometimes you just can't avoid these short-term things with people moving indoors and the cold weather. So we just got to get the EUA. The number one thing that can happen is accelerate the emergency authorized approval and get people vaccinated. Let's get 20 to 40 million people done by the end of the year. Plus you got another 30 to 50 million that have antibodies. And then you get the other couple 100 million. You probably only need 100 million after that. You can do that by March, April. And we've got herd immunity and we're off to the races. So it's coming. Okay. The catalysts we went through. Institutional sentiment we covered. So here was the yield curve expectations. I want to show you when the yield curve expectations got this high the last 3 times, here's what happened to financials. Beginning of a new cycle. This one is probably the most appropriate, where you had this huge spike off the bottom in 2011, sideways consolidation, and then a multi-year run. And that's kind of like what we're looking at right now. Expectations are at the same level. Same thing in 2016. So this is very, very good that yield curve expectations are at highs. Same thing happened. We talked about the dollar the last time that many managers expected the dollar to start to decline was 2002, and the dollar declined 40% after that. We had that same read earlier this year, and the dollar's weakened since. So this is a really, really good indicator and really, really promising for banks and financials. Wells Fargo update up 25% off the Cobra Kai sweep detour, and now we're back up, and we've actually gone up a little bit more. So that's really good to see. That's starting to play out. The long-term chart has really done well. This was some leg sweep here. They took us below this. This is volume by price. These green lines, 15 out of the last 16 times you had the green cross the red. I don't use this a lot, but it just had such a high productivity, high ratio. When that crosses, you see these huge bounces, and we're well above this now, this support, and we're basically clear blue skies until here where you have overhead supply in the 40s. So I think this is, and what's interesting is when you do get these crosses, the move tends to be pretty abrupt. It's months back to new highs. So look at this, straight up. This one, this one was abrupt, straight up. Once you get that real cross here, like we have here, this one was a monster straight up. This was almost like parabolic within a month. Went back to new highs after this long drawn out thing like we've had here. And once it bounced above, it just straight up. So you see that straight up, straight up, straight up again. This similar situation in 11, boom, straight up, new highs within months. Straight up here, same thing in the crisis, same thing even before the crisis. So this is a really, really promising side. The fundamental story stayed the same. We're still trading at a 40% discount to book. It's done that 2 times in the history of the company in 40-something years that I have the public data. And both times it recovered to book value and then new highs in months, not years. So this is all looking well, and the patience will pay off and is starting to pay off. We covered the Mnuchin. I had to put this in Borat because Secretary Mnuchin was on CNBC this morning talking about it's actually $580 billion. And he kept saying the lending facilities were a great success. The lending facilities were a great success. And they were a great success. And he'll go down as one of the best public officials in the history of the country. Him, along with Chair Powell, for what they did in the middle of the crisis in March and April. They saved us from a depression. But when I heard great success 3 or 4 times in the interview, I had to put a picture of Borat with the caption. And what he said was, now Congress needs to reappropriate the unused $500 billion to small business and the unemployed. And you should click here and play the interview. He did a great job. This is the exact same setup that President Trump created with the executive order, just getting the aid to the people who need it, going around the noise and the politics, and just going straight to the people. And we're going to see more of this, and I think there's going to be relief is on the way, and that could be the catalyst for the Santa Claus rally, which is really, really positive to see. So that was that. Finally, estimates again came up this week, 169.80. They were just 163 about 2 months ago, so that's positive. And then the economic data. So the rig count came down a little bit. That was good to see. Existing home sales shot the lights out. I think that was the biggest number in 14 or 15 years. 6.85 million. Existing home sales month on month were up 4.3% versus negative 1.2% expectations. We talked about people were probably delaying because of the election uncertainty. Well, that came back. No, this is an October number. So no, it's just hot as hell is really what it comes down to. It probably mortgage rates spurred this, hitting all-time lows. Philadelphia Fed manufacturing. This was a huge beat. This is an important number. 22 expectation, hit 26.3. People were focused on the wrong number. Initial jobless claims was 742 versus 707 expectations, but continuing claims continue to drop. It was expected at 6.4. It was down to 6.37, down from 6.8 last month. So that was really good to see, or last read rather. We had the crude inventory draw was better than expected. It was a build of 760,000 barrels versus 1.6 million estimates. But people got a little spooked by the gas builds, gasoline inventories. I think that's just a short-term phenomenon. And again, we're going to get the extension of the 7.7 million barrel a day cuts for another 3 months. And that'll keep us drawing down. So that's a good thing. Housing starts were very, very strong, 1.53 versus 1.46. Again, secular trend. Building permits were the same as last month, but a little bit below expectations. What else do we have here? Capacity utilization rate was up. That was good to see. Beat estimates and beat last month. Retail sales were positive, but a little light. So a little bit of consumer uncertainty, probably with the soft shutdowns, probably going into the election. This was for October. But I think that pent-up demand will come back in, hopefully if we get the stimulus and with everything else, and the vaccine starting. So that's a good thing. So retail sales we'll keep an eye on. China data, which we always like to cover, industrial production crushed 6.5% growth expectations. It hit 6.9. Retail sales were a little light, but remember, they were negative just 3 months ago. They were up 4.3%. Versus last month was 3.3%. It just missed expectations a little bit, was 4.9. And the unemployment rate stayed at 5.3%. Remember, they're a few months ahead of us. We'll be headed down to those numbers as well. So a lot of positive things happening. And that's it for this week. So we're going to see you back here next week. Same time, same place. Thanks for listening in. Hope you found that helpful and make it a great one.